Investing in the stock market can be both exhilarating and intimidating. The allure of high returns must be tempered by the reality of potential losses. With 2025 on the horizon, the market landscape is evolving and savvy investors need to adapt their strategies to navigate the complexities of today's financial environment. Whether you're a seasoned investor or a newcomer looking to make your mark, these 5 tips will help you identify winning stocks to help you usher in 2025. 1. Focus on industry trends. Understanding industry trends is crucial when picking winning stocks. Several industries are poised for significant future growth due to technological advancements, regulatory changes, and shifting consumer preferences. Sectors such as renewable energy, artificial intelligence, biotechnology, and cybersecurity are expected to lead the charge. Let's have a brief look at these. So, renewable energy, as the world intensifies its efforts to combat climate change, companies involved in solar, wind, and other renewable energy sources are likely to see substantial growth. Governments are offering incentives and consumers are becoming more eco-conscious, making this sector a prime target for investment. Artificial intelligence. So AI is transforming industries across the board from healthcare to finance. Companies that harness AI to improve efficiency, reduce costs, or offer innovative products and services are likely to outperform in the coming years. Biotechnology. With an aging population and ongoing health challenges, the biotech sector remains a hotbed of innovation. Breakthroughs in gene editing, personalized medicine, and vaccine development can drive significant stock gains. Cybersecurity. As cyber threats become more sophisticated, the demand for robust cybersecurity solutions is growing. Companies that provide cutting-edge security technologies will likely benefit from increased spending in this area. When choosing stocks, look for companies that are not only leaders in these industries, but also have a strong pipeline of innovations and a clear vision for the future. 2. Evaluate financial health. No matter how promising an industry or company might seem, it's vital to evaluate the financial health of any potential investment. Key financial indicators can give you insights into whether a company is well positioned to grow or is most likely to struggle in the future. Here are a few indicators. 1. Revenue and earnings growth. Consistent revenue and earnings growth over time is a strong indicator of a company's ability to thrive. Look for companies that have demonstrated stable or increasing growth in these areas. 2. Profit margins. A company with healthy profit margins is most likely to withstand economic downturns and maintain profitability. Gross operating and net margins are all important to consider. 3. Debt levels. High debt levels can be a red flag, especially if the company's revenue isn't growing quickly enough to cover interest payments. Look for companies with manageable debt levels relative to their equity or debt to equity ratio and earnings interest coverage ratio. 4. Cash flow. Positive and consistent cash flow is a sign that a company can sustain operations, invest in growth, and return value to shareholders through dividends or share buybacks. A deep dive into a company's financial statements, income statement, balance sheet, and cash flow statements will give you a clearer picture of its overall financial health. 3. Analyze competitive position. The competitive landscape across industries will continue to be fierce. Understanding a company's competitive position can help you gauge its potential for sustained success. Companies with a strong competitive edge, often referred to as a moat, are better equipped to fend off rivals and maintain market share. Here are a few things to consider. 1. Market share. Companies that hold a significant share of their market are often leaders for a reason. They may benefit from economies of scale, brand recognition, or superior distribution networks. 2. Innovation and R&D. A commitment to research and development (R&D) is essential for companies looking to stay ahead of the curve. Those that consistently innovate are more likely to retain their competitive edge. 3. Brand strength. A strong brand can be a powerful asset, creating customer loyalty and allowing for premium pricing. Companies with well-established brands often enjoy a durable competitive advantage. 4. Barriers to entries. Companies operating in industries with high barriers to entry, example, significant capital requirements, regulatory hurdles, or proprietary technology, are often better protected from new competitors. By analyzing a company's competitive position, you can identify those that are likely to continue leading their industries and delivering strong returns. 4. Consider valuation. Valuation is one of the most critical aspects of stock pricing. Even a great company can be a poor investment if you pay too much for its stock. Conversely, a reasonably priced or undervalued stock can provide substantial returns. Here are a few things to consider. 1. Price to earnings ratio or PE ratio. The PE ratio is a commonly used valuation metric that compares a company's stock price to its earnings per share. A high PE ratio may indicate that the stock is overvalued, while a low PE ratio could signal a buying opportunity, assuming the company's fundamentals are strong. 2. Price to book ratio or PB ratio. This ratio compares a company's market value to its book value. A low PB ratio may suggest that a company's stock is undervalued relative to its assets. 3. Price earnings to growth ratio or PEG ratio. The PEG ratio takes into account a company's earnings growth, providing a more nuanced view of valuation. A PEG ratio below 1 could indicate that a stock is undervalued relative to its growth potential. 4. Discounted cash flow or DCF analysis. DCF is a more sophisticated valuation method that estimates the value of a company based on its future cash flows, discounted back to their present value. While more complex, DCF can provide a deeper understanding of a stock's true value. By assessing a stock's valuation, you can make more informed decisions about whether it's a good time to buy, hold, or sell. 5. Monitor macroeconomic indicators. Finally, it's essential to keep an eye on broader macroeconomic indicators that can impact the stock market. While individual companies may be strong, external factors can influence their performance. Here are a few things to consider. Interest rates. Central bank policies on interest rates can have a significant impact on the stock market. Lower interest rates tend to support higher stock valuations, while rising rates can lead to a market pullback. 2. Inflation. High inflation can erode corporate profits and reduce consumer spending, negatively affecting stock prices. Companies that can pass on higher costs to customers, or those in sectors like commodities, may fare better in inflationary environments. 3. Economic growth. GDP growth is a key indicator of overall economic health. A strong economy supports corporate earnings and consumer spending, leading to higher stock prices. 5. Global events. Geopolitical tensions, trade policies, and pandemics can all have unpredictable effects on the stock market. Stay informed about global events that could impact your investments. By keeping an eye on these macroeconomic factors, you can better anticipate market movements and adjust your portfolio accordingly. So just to recap, picking winning stocks for 2025 requires a blend of industry insight, financial acumen, competitive analysis, careful valuation, and macroeconomic awareness. By focusing on these 5 tips, you'll be better equipped to navigate the stock market's complexities and make informed investment decisions. Remember, successful investing is not just about picking the right stocks. It's also about staying disciplined, diversifying your portfolio, and being prepared for the long term.